Hello and good morning to everyone, or good afternoon as it is in England here, or good evening if you're in Australia, because I know it's going to be evening for you there. I want to welcome all of you to today's mentorship course, a 5-day course with the master, Tom Williams, the inventor of volume spread analysis. I'm very excited to have put this course together. We're going to go through a lot of the basics. We're going to go through some intermediate and some advanced stuff, culminating in an advanced trading session on Friday, where we're going to show the new volume thermometer. We're going to trade our live accounts. I had a lovely trade last week. I shorted the British pound on an upthrust in the downtrend and took 160 ticks out the market in 24 hours. If you were in last week's seminar, you saw that setup. It is on YouTube. Go and have a look at it. It shows you that, that these markets truly do move on supply and demand, and no supply and no demand. Also, I forecasted last week that gold would come down to 1,700, and we're trading around 1,720 at the moment. We'll talk about why we saw the end of a rising market today. So we're delighted to be with all of you. Thank you, all of you, for your support of Trade Guider. And this is a mentorship course that Tom and I have put together that goes through all the principles. So there's a lot of stuff here that you may have heard before, but there'll be some new stuff that maybe you haven't heard before as well. And as always, Tom and I will trade live on Friday with all of you as a group, and I do encourage you, we're going to be trading the futures markets and the currencies, the Forex markets. If you haven't already done so, you can download the same platform that we're going to use to trade, which is the Infinity AT platform. You can get that absolutely free with data for 30 days. And if you're interested in doing that, at the end, I'll let you know where you can get that platform. Okay, so let me introduce myself for those of you who don't know me, but I think you all do. My name is Gavin Holmes. I'm a professional trader. I'm an author of 2 books and a third book being published in December. And I'm also the Chief Executive of Trade Guider Systems International. And with me is the man that taught me pretty much everything I know about trading and investing. His name is Tom George Williams, and he's a retired syndicate trader and indeed the inventor of volume spread analysis, which is what we're going to focus on this week. So the way the class runs, we run for an hour and 30 minutes each day. We may well overrun some days, just so you know. We want you to learn, so we may well find that we'll overrun a little bit, but definitely you'll be with us for an hour and 30 minutes each session. We'll take a 15-minute break between sessions so that you can go and get a cup of tea, a cup of coffee, whatever your poison is, but please don't drink any alcohol because we've got lots to teach you. And we do encourage audience participation. So remember, there's no such thing as a silly question when it comes to trading and investing your own money. So we encourage you to ask us questions. And remember, if you have a headset and microphone, the way we've structured this mentorship course is you can indeed, by typing in question MIC, so question mic, it means I'm going to open the microphone and you can talk to Tom and I directly. If you don't like to do that, because there is a lot of you here, then you can just type your question in. And as I said here, and I mean this, there is no such thing as a silly question. Please ask it. Okay? Please ask the question. It's very, very important that you do ask. If you don't ask the question, you're not going to get the answer. Ken, I don't know if you can see there, but Sam's in the room. Sam Abbey. He's from Singapore. Great guy. Can you help him? He says he can't hear, but I know for a fact we've got sound because everyone else isn't typing in no sound. So maybe his speakers aren't working or something, but maybe you can help him, Ken. I also recommend that you take notes throughout the session because there's a lot of information that will be on the recording. Okay, but we do suggest that you take some notes. So the sessions are really the next 2 days. We're going to focus on the VSA principles, and we're going to have Tom explain each principle in detail. So pay close attention to how Tom describes the principle. Today, we're going to talk about accumulation and distribution. And then on Wednesday, Dr. Gary Dayton will come in and talk about springs and upthrusts, which are very, very powerful. At the moment, I'm making a lot of money trading springs. Okay, and we'll talk a little bit about what a spring is when we look at it in volume spread analysis terms. We'll talk about trigger numbers. We're going to talk about a lot of things, actually, and let me talk about the objectives in a minute about what we want to teach you. But Can you identify when a market is topping out and bottoming out? Absolutely you can. Indeed, in gold, I was so confident that gold would fall a couple of weeks ago. I saw a signal, my favourite, called the end of a rising market, and sure enough, gold has collapsed and had its biggest fall that we've seen for many, many years. Many months rather, back there in beginning of October. So we'll look at that, and then on Friday we're going to trade the live markets. Tom and I are going to focus on all the currency pairs. We're going to look at some stocks. We're going to trade mainly the futures market, the NASDAQ, the S&P and the Dow, and we'll trade gold and silver, crude oil, whatever we see an opportunity to make money, we're going to go and find it for you and show you how we do it. So the sessions start each day at 6 a.m. Chicago time. We will definitely overrun, I'm sure of that. So although it's a 3-hour session each day, we will take a break. You will get a break in between because there's a lot of information to give you. So those are the session times. And what are the objectives? Well, there's many. This list here has been put together by previous customers who've emailed us and told us what they've learned in these sessions. So hopefully this week you'll pick some of this up as well. Now, some of you here have been to more than one of our mentorship courses, and some of you, this is your first time. This is the first mentorship course you've ever done. There will be some repetition because there has to be. We always know that there'll be, the principles don't change. They haven't changed for 100 years. They're not going to change today. But what you will learn this week is some new information about the trending system that Tom has developed, which we're using in our hedge fund software. And again, because the markets at the moment are so volatile, there'll be some wonderful opportunities on certainly Friday for us to go and make some money in the market. So what do we want to teach you? Well, certainly better timing. Timing the trade is everything. How to cut losing trades quickly and know why you're cutting them. Tom had to do it the other day. Even the master has to cut trades. He doesn't always get it right, although he gets it right about 99% of the time. Sometimes, and he was right. Interestingly enough, last week in the live trading session, he was short, and then there was an upthrust. He closed his position, and then the market came off. I actually shorted that upthrust and made quite a lot of money. So, we always got to time our trades. Learn to trade well for the sake of trading well, said one customer. How to prepare mentally for trading. How to take fewer trades but better trades. That's something I've had to learn the hard way. How to deal with a delay on the daily data to set up for the next day. How to place stops correctly. Where is the highest probability entries? In VSA, we have about 10 very high probability entries. One of them appeared in gold a few weeks ago on the daily chart. It's a high probability. It doesn't mean it's 100% guaranteed. It's just a game of probability. That's what trading is, everyone. It's a probability game. But you can, by reading the chart, put the odds in your favor. Confidence is everything. And we hope at the end of this week, you'll have a lot more confidence to read the market correctly. How to identify accumulation and distribution. We're going to talk about this principle this morning. It's very important. Professionals accumulate something when the news is bad, and they distribute it when the news is good. We're going to learn where you exit a trade. When is it time to close it out? And one of the questions we get asked a lot, what is absorption volume? Okay, because everyone who studies VSA tends to pigeonhole themselves into the thought process of ultra high volume is always weakness, especially if it's on an up bar, which is, of course, we know most often that is a true statement. But there are times, especially in a bull market, as we're seeing now, where professionals, or smart money as I call them, are prepared to absorb any sellers to the left and prepared to mark the market up further. And we're seeing some examples of that. How to identify when a stock is ready to short or go long? That's not a difficult thing to do. We know that professionals accumulate on down moves when news is bad. To reinforce knowledge, existing knowledge that you may have gained through reading Tom's books or my books. So this is very much a session about reinforcing the principles. How to manage a trade and how to assess risk. That we will do on Friday. How to create a trading plan. I'll share with you a trading plan. Ron says, I'm struggling. Okay, my objective is to have an understanding that will allow me to trade at the end of this week. Ron, there's no reason you shouldn't. None whatsoever. None whatsoever. If you pay attention, if you stay focused, if you take notes, then you'll learn something that you will be able to trade by Friday afternoon. That I will promise you. Now, again, don't rush in. I always remember to tell people, practice, practice, practice. Because the big P is the way we learn anything in life. If I want to go and play golf or anything, I have to practice. I'm afraid there's no shortcuts. And the market is the biggest way of making money in the world and the biggest way of losing money. So practice is absolutely vital. And on Friday, we'll be in the live market as a group, all of us, okay, all together. And we will go and look for trades. So how to read the background correctly. How to build a small account using risk management. How to learn just one high probability setup. This is one customer a few months ago came in and said, Gavin, I don't want to learn them all. I just want to learn one principle that can make me money. Well, as it happens, Rita Offen, who was taught by Tom, I'm going to call her Mrs. Upthrust, because that is her trade setup that makes her a lot of money. And it's an upthrust. I mean, it's a very powerful signal to short the market. And you're going to learn all about them on Wednesday. How you maximize profitable situations. You know, it's very easy to trade. You think, I mean, when I say it's easy, you can push a button and be in the market. A monkey can press a button and be in a market. It doesn't take much intelligence. But as you'll see and you'll learn this week, knowing why you're pressing that button, knowing why your timing is important, knowing what the background is, which I talk about here, how to read the background correctly. The chart is a language, and you're going to learn a new language this week. We're going to teach you how to be a better disciplined trader. Now, how do we teach that? It's very difficult. I mean, I've met a lot of you in this room. Some of you from Sydney, some of you I met in Singapore, some of you in Hong Kong, some of you in Malaysia. And it's always a difficult thing to teach someone discipline. I'm not particularly disciplined at times, but I'm a good trader. That's because I'm very, very quick, as Tom will tell you, to get out of losing positions, and I let winning positions run. And do I still get aggressive? And do I have days when I make mistakes? Sure. Everyone does. Every good trader that I've met has a bad day in the market. I'm afraid that's just life. And you better get used to it. You're not always going to have winning trades. You've got to accept that. It's part of being a trader. And the ability to cope with losses and deal with losses is very, very important. Again, it's also important to maximize profitable trades. Get the most out of them. And that's what we're going to show you to do with Tom's trending system. And then how do you identify a sequence? Volume spread analysis, as you'll see, starts with ultra high volume very often. Not always, but very often. And then a sequence occurs which allows you to get in and take a trade. Here's some other things that people have told us they wanted to learn. To learn all the VSA principles and then put them into context, including background and trade setups. Today, you're going to learn trade setups. You're going to learn all the principles of weakness today, and we're going to cover that in sessions. And tomorrow, we're going to cover signs of strength. We're going to look at where the highest probability entries are. And in fact, you know, I traded one live last week, the upthrust in a downtrend, very high probability. You're going to learn why professionals distribute and accumulate and know when they're doing it. And the trouble is, the news will wrong foot you. Your own brain will be telling you to do the opposite of what you should do, which is why so many traders lose money. To learn how to identify the top and the bottom of a market. To understand herd behavior. I'm afraid that's the truth about human beings. We do act in a herd often, and that's what causes us to lose money. We'll understand and teach you what weak holder is and make sure that you are not either of these groups. I don't want you to leave Friday and be a herd trader or a weak holder. We'll learn the shakeout. It's a very important signal, and it's exactly what happened last year in August as the news came out about the US downgrade. We'll talk about the upthrust, and we'll do that on Wednesday. And we'll talk a bit about it today because we're going to talk about signs of weakness. And the upthrust is so obvious when you see it. If you just traded upthrusts in weak markets, then you do very well. But you do get upthrusts in strong markets, and they're not the the place to take short trades, as we'll explain. So we'll talk about the significance of the range or the spread of the price bar, okay, because that's important. Everything is in context, and it's in context with the background of the chart. We'll learn why multiple time frames are important, and they are very important. We don't just want to look at one time frame. We want to look at more than one time frame. That's extremely important. Okay, sorry about that. I'm just doing a quick sound check again there. There you are. I'm still here. Yeah, so we're going to look at the background of the chart and why the background is very important, okay? And multiple time frames. You know, the market is moving every second that it's open. So do you trade a 1 minute chart or an hourly chart? Difficult question to answer for some of you. I will share with you my trading plan and share with you what time frames I've particularly found useful, and we'll show you in a live market how we scan for actual trade setups. And then we're going to talk about the test. Now, the test does seem to confuse a lot of you, and the test is a very important signal, especially in a bull market, which we're currently in. And we'll talk about that as well. So, let's talk about what qualities make a good trader and investor. Now, I have met thousands of traders and investors from around the world in my 10 years of doing this. I'm very blessed to be able to travel the world and teach and meet a lot of great people. I've also met the smart money. I'm going to be working with a smart money trader in our hedge fund here in England. His name's Mike. He's the 4th biggest gold trader in the world. And these people exist, and it's nothing for them to trade 5,000 contracts in a market at any one time. And I've seen this happen. I've seen this being done. So do not think for 1 minute the smart money don't exist. They absolutely do exist. And they're very nice people. Let me just be clear. But they're also predatory. They don't care. They've got no friends in the market because they are there to make money. Just like you would be. You are there to make money for yourself. So are these professionals. And they all have these qualities. Patience. It's a big one. They're very patient people. They know the market will give them a great trade setup at some point. If it doesn't happen while they're looking at the charts, they wait. They don't rush in. As Tom taught me, you don't get on the wrong bus. You get on the right bus. If your number 5 is what you're waiting for and a number 3 arrives, don't get on it. Most retail traders jump on the wrong bus and end up in the wrong destination, which is losing money. Timing. They're all good at timing the market, and timing is everything. Confidence. Confidence is a very important part of trading. Confidence is a very important part of anything you do in life. If you have the belief system in your ability to make money in the market, you will make money in the market. But a lot of people don't know how to deal with losing positions, and they don't then have confidence, or they lose confidence. This seminar will build your confidence, that I know. Study. You've got to study the charts. The charts are a language, and we will teach you the language. Then you've got to put the work in. There is no shortcuts here. You've got to do the work. Self-discipline. Don't rush into trades that are not there. It took me probably a year of Tom sitting next to me, smacking me around the back of the head when I took a bad trade, to know that I was getting on the wrong bus. Don't get on the wrong bus. Become a master of volume spread analysis. What we're teaching you is the truth. Someone said they want to do what experts do in VSA, like Philip Friston, like Tom Williams, like myself. We're going to teach you what we do this week and what we look for. A desire, a will to win. I mean, a lot of people that have met me said to me, Gavin, you seem to have so much energy and you seem so passionate about what you do. That's because I have a will to win and a desire, not just to help myself, but to help others too. That's a passion that burns within me, and you can have it too. If you want to win in the market, you need that desire though. You need to be hungry. You need to focus. You need to be focused at all times. You can't take your eye off the market. As Tom said, it's always like this. We see a setup. We think it's coming. Tom says, Gav, go and make me a cup of tea, will you? As I go and make him a cup of tea, the market collapses and we didn't take the trade. So you've got to be focused. You can't take your eye off the game. And you've got to understand the game and be open-minded to what we teach you. What we teach you is the truth about the markets. You need to have belief. Believe in your human ability to make money because you've been given it. You have the ability. You've already taken a big step in your belief system by spending money to be with us today. You've given your time to be with us today, which is extremely valuable. So you are doing the right thing. You're becoming educated. You must have a trading plan, and we'll share a trading plan with you this week. You must have, and I say must, you must have good risk management. And we'll talk on Friday about how to mitigate risk, how to know when to trade certain account sizes and what you can and can't trade. As Tom taught me, you must concentrate. You must focus. It's so important. When you press that button and you're in the market, you're trading against some of the most intelligent beings on this planet. And don't think that isn't a true statement. I know, I've met them, and they're very clever. The reason I wrote a book called Trading in the Shadow of the Smart Money is because these traders are very smart. And they've also got a lot of money. In fact, in Australia, I think it's Greg Kofi, who just retired from a hedge fund, is said to have made somewhere in the region of $600 million as a hedge fund manager. And he didn't do that through not concentrating and not being focused. Be independent in thought. You have been given the gift of thought and the power of your brain. It's why you're here. Use it. Use it carefully and wisely and you'll make money. Always be contrarian. Don't believe everything you see on the TV and the radio and the newspapers because it's probably not there for your benefit. Learn to cope with fearful thoughts. When you have a fearful thought, understand that it's simply feedback from the universe. It's feedback to help you, not to make you panic. So learn to cope with it, and we'll talk a little bit about that today. Tom often talks about trading as being like a soldier in the army. And you go into the market, and if you're trading certainly these very small time frames, it's like being in the trenches of World War I. You're popping your head up thinking, am I going to get shot today? We're going to teach you to know when to move out your trench and go into the market. Follow the system that you develop for yourself. We're going to give you a lot of information this week, but it's important that you adapt what we are going to show you to your personality style. I've met some of you in this room, and you're all different. That's the wonderful thing about becoming a human being. We're all different. But there are a lot of things we're going to teach you that will apply to every single trader, whether you're aggressive, conservative, whether you're experienced or inexperienced. And please, if it doesn't go right, if you're in a position and it's going against you, just close it. There's no reason to be in the trade. Okay, so let's get to the meat on the bones. What is volume spread analysis? What is the main concept behind it? And why is it all related to accumulation and distribution from the smart money? Okay, so I'm going to bring in Tom now to talk to you about the concept of volume spread analysis. And we're going to talk about this trader here, Richard DeMille Wyckoff. So let me pose you all a question. Has everyone here, yes or no, heard of the trader Richard DeMille Wyckoff? Yes or no? I just get a few. I'll be surprised if anyone said no, but if you haven't, don't worry. But this man is the man that we honor, even though he's passed away, for the work that we're about to show you. So everyone has heard of Wyckoff, who is a fact trader in the early 1900s. And the method that we're teaching you is all about establishing why a market's going to move. So the cause, everything, the universe we live in, works on a law, works on many laws, but one of them is called cause and effect, effort versus result, supply and demand. These are things that we hear about, but most people don't understand them. And we're going to talk today about what causes that price to move. It's not an accident. There are no accidents in the stock market, in fact, in any market. Things are moved by the smart money. Now, the cause is simply the imbalance of the supply and demand situation as the market unfolds. And that results in strength or weakness appearing in the market that you're trading. But for the correct analysis of the volume, you need to understand that the recorded volume contains only half the knowledge required for a correct analysis. The other half of the knowledge is found when observing the spread or the range of the price bar. And then what did the closing price do on that bar? Volume indicates the amount of activity. That's the key to it. Volume indicates the amount of activity on the price bar. And the spread or the range of the bar shows what the price actually did. But most importantly, where the price closed. So here is VSA 101. Volume, range of bar, closing price. But here's the key. We don't just look at one bar in isolation. We compare the bar to the background, and then as each bar follows it, we look at each bar to tell us a story. And that story determines the behavior of what the market's about to do. Markets change behavior just like human beings change behavior. You can wake up one morning, get out of bed, as I usually do, and you'll be in a great mood, and you'll be happy, and you'll be overjoyed. I try to do that every day. I make a point of doing that. But there have been days when I've got out of bed and felt sorry for myself, felt a bit down, a bit negative. I don't do that very often, I must add, anymore. I've changed my whole thought process. But it did happen to me in the past. Some people out there get depressed. Others are very happy. Why? Well, they change their behaviours. And it depends. Every day is a new day. Well, the market changes its behaviour every moment, second by second, moment by moment. As Wyckoff taught us, the market changes its behaviour, and it's all in the volume, which is the activity of the smart money. So let's introduce you all to Tom, who's going to be doing this course. You can hear a lot from Tom these next 5 days. And he says here, if you can read a chart correctly, you will understand the markets do not move randomly, but are moved by the smart money. And you can see their intention at support and resistance levels by looking for the telltale footprints hidden in the volume and price. And you can then have a chance to profit by following in their footsteps. Volume is vital in your analysis, which is why, ironically, the self-regulated exchanges around the world will not release true volume figures until the day after day trading took place. So, please give a warm welcome to the master, Tom Williams. Tom, the basic concept of volume spread analysis. Can you explain why volume spread analysis is so important to a trader?
Right, thank you, Gav. Yeah, hi, Tom Williams here. Lovely to talk to you. Right, well, that's a huge question to answer straight off.
Start with a difficult one.
Start with a difficult one, Gavin says. Anyway, volume is absolutely vital to us, of course, because that's the amount of activity that's going on at that moment. Now, I've been watching the 15-minute chart this morning. Right. Could you put a 15-minute up for them to see?
Yep. Just bear with me.
Because there's two principles here which are pretty obvious, especially in hindsight. But don't get alarmed if you get it wrong, right? It's not that the market's lying to you. It's not that the principle isn't true. It's just this morning, Gav.
Yeah, I've got it. Yeah, we can see it.
Okay?
Yeah, just here.
But remember, the mind is a very complex bit of equipment you have. And it's odd how it works at times. I mean, I speak to Peter often. You know, he's a computer expert, comes up and helps me. And be quite honest, he's a bit overweight. Okay, I could lose some weight. So you would think logically that as a human being, you think, right, okay, look, you're overweight, right? Or you smoke, or you do this, or you do that, right? For your own good, that is, stop it. But you don't, you can't. Now, what I said to Peter, of course, in a jokingly way, I said, trouble is, Peter, is don't forget that you've got two parts of your brain. You've got the cerebral cortex at the top, which everybody knows immediately. They show pictures of it, the grey matter, right? But what they don't tell you is that you also have a primitive brain at the base of your skull. I used to know the name of it, but I've forgotten now. But it's that part.
The amygdala.
Is it an amygdala?
Yeah.
Right, Gavin told me, he knows more than I do about it. Anyway, it's that part of your brain that allows you to go to sleep, and you can breathe, you perspire, you do this, your kidneys work. Everything is working nicely while you're sleeping, okay? So this is the primitive brain. But the trouble is, when you get, say, hungry, we're talking about dieting, the primitive brain realizes that you're hungry. So it starts saying, let's eat, I want some food, right? And it looks up at the cortex, which is above, and says, now stop all that nonsense about dieting and this and that and all the other things. Let's eat. And you've got to be so well, I don't know. It's very, very difficult, as you probably know, to overcome those impulses from that primitive brain. So keep that in mind. You know, if you have any failures in trading, it's not that the principles are wrong or anything. It's probably that you've just got it wrong. Because I always say the human being is the weak link here. But look, have you got the 15-minute chart up?
I have, yeah. Mm-hmm.
Okay, now look. Put the cursor on this lower bar here. Here.
Yep.
Right, those two bars. Mm-hmm. Got it?
Yep.
Okay, now, the market, without question, moves on supply and demand. And you see these principles all the time. Well, very frequently. Okay. And what happens is that the professional, the smart money, Gavin calls it, are traders that think nothing of throwing 4,000 or 5,000 contracts into the arena with the anticipation of higher prices, right? And they may join other professionals, and there's groups of them as well. It's no good asking too many questions, but we know that when we see a surge of volume, like we see at the bottom here, look, on those two bars, and admittedly, the second volume appears to be on a blue bar, which is an up bar. But remember, you've got this bottom tail attached to it. And that's where probably the buying came in. Got that, Gav? Mm-hmm. Right? Okay, now, if that area of supply that we see there is tested of some time, then the market's going to go up. Right? So if you believe that, you have to concentrate. Because then, okay, it goes up, one bar, we have a black bar, level bar.
My bars are a different colour, so don't worry about the colours.
Okay, don't worry about the colours, right. Now, lo and behold, this is what we're looking for. We have a down bar, look. Is that it, Gav?
Mm-hmm. Yep, I'm following.
But look at that low volume. Look. Relative to this high volume over here. Now that means that there was definitely buying on those initial down bars, and now the market's fallen back down into that level or that area, and the volume is low. That tells us that there is no selling pressure on the downside in the market. Right? That means that the so-called smart money, there'd be somebody selling, but not the smart money, look. Because that's indicating a very, very low volume. That means the balance of supply and demand is telling you that demand must be greater than the supply. And that's why the volume is low. Now, you see this all the time. It doesn't come in exactly the same sequence as this. Sometimes there's a few more bars. Sometimes it tests a bit lower. But then your ability to read these charts, as Gavin says, it's a language. When you read the chart, it's like Braille. You're looking at a language. But whenever you see that, you know you're going to get higher prices.
Okay, there's a question from Gling.
Yeah.
He says, after you see that, the very next bar goes up, but there's very low volume. It looks a bit like low demand, but the next bar recovers, which means obviously there can't be no demand there because the next bar would close lower. So if you just want to explain, would you be concerned if you were going long about the low volume on the other bar?
You're not concerned about the low volume on the next bar, because what they say to that is the reason why it's gone up on low volume after two serious signs of strength, right? Two very, very serious. You've got to believe the principle that there is no supply. And the reason they say the next bar can go up on low volume is there's a shortage of stocks at that level. There's a shortage of supply. So they have to crawl up, mark it up, right? But your main influence is these two bars behind you that have strength. Now, if you had weakness behind you and you saw no demand, that's a different story altogether. But we're talking about the principle of going long. Now, if you nail that into your brain somehow and waited until that sequence appeared, which it does very, very often, you would be a very, very poor trader if you couldn't make any money. Very poor. Okay, so on that principle, the market went up, look, 1 bar, 2, it went up 3 bars, but then bang, there's some supply or no demands appeared at the top here. Look, we have a
supply coming in, number 26.
We have a signal. Now the computer can read, it reads what you told it to read, just like I'm telling you. Now, unfortunately, there are no signals on that particular time frame on the low there. But I'm sure there will be signals on different time frames. But on this one, look, there's a sign of weakness came in after an up move, but notice that the up move isn't all that dramatic.
On the 7-minute chart, just so you know, we did have some signs of strength there.
Right, okay. So on that weakness there, which the computer's telling you, if you press F1, okay, right, the market drifts off, look. And you've even got a no demand bar there, look, Gav.
Yeah.
And that's why it's drifting off at the moment. So there's nothing at the moment that I would rush in and want to trade that. Although it's a down bar now on a little bit of increased volume, definitely. But you have to wait for confirmation. You have to wait till you clearly see your bus with your number on it. And then you go in. But, I mean, when I first started, I didn't know what on earth was going on for about 2 years. So don't be, don't be surprised if it takes a little bit of time to get to grips with this. Although it logically appears to be so simple, I don't know. You have to figure that out for yourself. It's something to do with a conflict between your primitive brain and your cerebral cortex, probably arguing with each other, I don't know. But they're there for a reason. And, of course, that would be your survival when you were a caveman. I love bringing the caveman stories in.
You love your caveman stories.
Yeah, well, the caveman, you see, can they hear me?
Yeah.
Okay, sorry. I mean, I always talk about the caveman standing at the entrance of the cave with his spear, right? And his wife's in the back there with the children and the fire and all the rest of it. But the caveman had to have, see, men, they enjoy taking a bit of risk, right? They're not all cold and logical like a computer. They enjoy having a little go. They get a pleasure out of it. They get a pleasure of going to play a game of tennis and beating somebody, right? But they beat somebody that's allegedly better than they are. That's where the pleasure comes in. But, you've got all this to contend with. And if you can think carefully about it and try to, I would almost suggest you write a list, a checklist that you should really have to check before you trade. The market seems to be coming off quite dramatically at the moment, look.
Yeah, that's because of the no demand at point C here that I might.
Oh, yes. Okay, well, I'll hand you back the gab for now.
Okay, yeah, so we're seeing the market fall, and this sequence up here, which we're going to talk about in the PowerPoint slides, is a sequence. Okay, I'm actually taking a screenshot of this, which I'll put into the PowerPoint and send you, because it's a good example of how weakness appears. Here's your supply coming in. Here's more supply. Notice the narrowing of the spread on this bar here, and then we have no demand. And it's been confirmed as soon as the market starts to move down through the low of that bar, that even against the trend is a potential short. The reason being they're going to come down to 1425 and retest this area. It happens quite frequently. So I've put here the buying appears at A, as Tom explained, and is tested at B, and that causes the price to go up 2 or 3 points. But then an opposing principle appears. Here we see weakness. And then at point C, the weakness is confirmed. So I'll put at point C, the weakness that has now appeared. You saw this happen live, so this is important. Is confirmed. So through this session and through all of our sessions, if Tom sees a principle live, this is how we're going to do it. We're going to screenshot it and add it to the PowerPoint and send it to you. So let's save that and call it Tom1 and save it to my desktop. Okay. And if we go back and actually have a look at the chart, you can see that the market has indeed fallen on very high volume. It's taken out its prior support, and now you'd expect the market to come and retest 1426. However, we'll come back to that. We're going to do plenty of live charts as we go through. Now, Richard Wyckoff, one of you said you didn't know who he was, so that's absolutely fine, and thank you for telling us. Here is a website that's got everything you need to know about Wyckoff for your study, and here is a website that explains who the players are. And when I say the players, the teachers, the educators, and the people that really are part of what we're going to show you over the coming 5 days. And I'll put that link up as well. And Dr. Dayton, Dr. Gary Dayton here, has just come back from Australia and Malaysia and Singapore with me. Philip Friston is a fund manager here in England. Tom, you all know, David Weiss has invented the Weiss Wave and is a Wycoffian expert. Tim Raymond won a trading competition, not once but twice, using VSA in Forex. Richard Ney wrote a book, several books actually, but 3 of them I think are great books. Making It in the Markets was one, about how the markets are manipulated. And Jesse Livermore wrote books on the market. He was the smart money, but he wanted to help people too. And then, of course, you've got Wyckoff. I don't know why we got 2 Tom Williamses there, but obviously he's very important. And then, of course, there's me as well. So Wyckoff taught us why the market moved. Now, Wyckoff also taught us the key points to trading. And here they are. Now, I'm going to spend a little bit of time on this PowerPoint, this part of this slide. Jitendra, good to see you, says, can you have full volume area 2, please, underneath? I think you mean, can you have the, yeah, I think I did take the screenshot of that underneath here. So you want a screenshot of the bigger picture, is that what you're talking about, Jitendra? Because I can take a screenshot of that later. Yeah, I'll do that later on. I want to see how this develops, and we'll take another screenshot of this trade setup as it develops. So what do we look at when we're looking at a chart? We look at the big picture. We look at more than one bar. Most traders that I know that are not making money tend to look at only the right edge of the chart, and they're using maybe a technical analysis tool like a stochastic or a moving average. But the stochastic and the moving average can be your enemy if not used correctly. Why? Let's go and have a look. As this market rallied, a 20-day moving average at this resistance level would be giving buy signals. Everything in Trade Guider says at this moment in time, the market is going up. The diamonds are green. And if I put the coloured bars on, you'll see that they've turned blue. But why do I need to look at the background? Because I've got a clear resistance level to my left. There was selling pressure on a very high volume bar back in February. Then why is February relevant to today? Okay, it's relevant because the market's gone back up there, and look at the volume now as it gets up to this top. But look at the narrow spread on the bar. Then it's confirmed a few bars later with no interest in higher prices, with a bar that closes lower. And I've got a screenshot of this to show you. That's called no demand at a market top. And it's all about the background. Notice one of the things that Tom taught me, which is I'm going to get him to talk to you about now, is support and resistance levels and the importance of trend lines. Now, in Tom's shed, I think you've still got it, is this 7-foot ruler. Yeah. And I'm going to get a picture with you and your ruler. We'll send that to everybody with the DVD. Yeah. Now, what was the importance of drawing trend lines and support resistance levels on a chart when you were working for the syndicate? And why do you think they're so important? You, on all your seminars, you put trend lines on, and you say, look, it hit the bottom trend line, it hit the top trend line, and the market seems to respond at those levels uncannily. There doesn't seem to be a reason for it. We don't know why these lines work. But explain to the group now why trend lines and support resistance lines are vital in their analysis.
Well, yeah, thanks, Gav. Okay, well, we know that so-called trend channels work, right? And that's why I don't feel at all comfortable looking at the chart unless there's decent trend lines drawn on it. Now, I realized that in the early days when I was instructing the programmer to what to put into the software. And luckily, he picked it up pretty quickly, and the computer loves all this stuff of projecting a potential trend line, even if you can't see it, way into the future. Because believe it or not, whenever the data, if it may not reach the trend line, but if it ever reaches that trend line in the future, you can bet your bottom dollar something will happen. And then what you do, you can see more or less what's happening at that resistance level or support level way into the future. For example, if you saw an upper trend line and the market went up there, and of course it gapped up and you had a very narrow spread, very high volume, you know that's a potential signal coupled up with the fact is it's right at the top of the trend channel, which makes it vulnerable to professional money. Lots of them do trade on these trend lines, so keep that in mind as well.
Mike Shirley that trades all on trend lines.
Mike Shirley.
Yeah, the fund manager. Yeah, you know Mike.
What, down in Swansea?
Yeah.
Oh, does he?
He looks trend lines all the time. Yeah.
Oh, no wonder he runs VSA.
Yeah.
Yeah. Okay. Well, there you are. Gavin said that there's this fund manager that is very active down in Swansea, Wales, here in England, and he trades mostly on trend lines because they work. But we can go a step further than that. When the data, or if the data reaches those lines, right, you better read the market at those points, which is very interesting. And of course, a past level of resistance or support is also important. Gavin calls them trigger levels, and that's also important. For example, if you see a widespread down closing on the low with a slight increase in volume, not excessive but not low, as it rushes towards a former area of support, which would be to your left, that's a sign of weakness, potential sign of weakness, which I think we saw last Friday. Well, we did see it last Friday.
I'm showing them a chart, gold daily, which had exactly everything you're describing. By the way.
Oh, right. Well, gold, apparently Gav's got gold up. So they're very, very interesting. But Wyckoff, right, which was a trader 150 years ago, whenever it was, he more or less told everybody how to draw trend lines. If the market is bullish, in other words, if it's going up with support levels higher, then you draw your trend line between the first two lows and the corresponding first high and project them well into the future. And of course the computer does that for you automatically. And if you ever look at those trend clusters, I personally don't use them, to be quite honest. I just concentrate on reading the bars on the live chart. But I've looked at them and they're fascinating. How the volume doesn't seem, the closing price doesn't seem to like to be within the body of the trend cluster. It seems to doesn't like it. And it's quite interesting if you look at it. But you know what's going on there. Now, why these trend lines work, I've never really put the thought into it to sit down long enough to try to figure it out.
Can you just tell the group I've just drawn a trend line on the E-mini S&P futures daily chart so they can see how it works?
Gavin just says he's just drawn a trend line on the E-mini futures. But I'm sure there's a lot of clever of you people out there. And it's something to do with herd behavior, obviously, because you can draw a trend line on any subject in the world as long as you've got data. And this is data, and that's what we're blessed with from the stock market, because we have all the data. I mean, for house prices, if you had correct data, you could do the same thing, and would probably predict movement of house prices extremely well if you had the data. I don't know, perhaps some people do. But
there is something called the Case-Shiller, which does exactly that, and it showed no demand on the weekly chart. I've actually done it. I'll show you it.
Well, Gavin will tell you a little bit more about that.
Yeah, there is indeed a data that you can get for the housing market and the CME group. It's called the Case-Shiller Index. Some of you may know that. And so you can see that at the moment, housing is showing no demand as the market is trying to go up. And that's why I'm actually in the process of looking for property here in England and also in America and France. I'm looking at 3 different properties. And the same thing is happening in all 3 places, is there's lots and lots of property on the market, which means supply is overcoming demand. There's too much property. And that's because people have got underwater with their mortgages and all sorts of things like that. So we see that there's a lot of supply in the market. So as it tries to go up, people are just sitting on the sidelines waiting for prices to fall further. And Tom and I watched a very interesting program last night about the tulip market, didn't we? In Holland, years ago, hundreds of years ago. 200 years ago, how they marked the price up, and everyone was trying to buy these tulip bulbs until finally very wealthy people were sitting on these big tulip bulbs, hundreds, even thousands of them, trying to sell them to the next person. And suddenly, at an auction in Amsterdam, I think it was, they decided that, this is ridiculous. It's a Case-Shiller, Lars. Case-Shiller, C-A-C-E, and then Schiller is S-C-H-I-L-L-E-R, Lars. And good to see you, by the way, Lars. Case-Shiller Index. And interestingly enough, we watched the program as we were preparing for the mentorship course today, and we both laughed. We said, well, this is the market, isn't it? They get these tulip bulbs, they mark them up, get everyone excited at the top, and then suddenly there's no demand, and the whole thing falls. And in fact, at the very chart that Tom is looking at right now, the 15-minute S&P, that's exactly what's happening. The market, if we look at the chart here, has gone up here, been marked up, then there's no demand at this level, just here, and then there's more no demand, and that's why it's fallen. And we're now going to talk about why that happened. So Dave's asking, what's the multicolored background in the volume chart? Okay, this is built into the program, and it defines when we have unusually high volume. If it's in this salmon colored area, we know that the volume is unusual. And if it's down here at the bottom in any of these bands, below the blue line, it's unusually low volume. So here's your high volume on a down bar. The next bar closes up. We get a test. Notice the volume is less than the previous two bars. That's why the market went up. Now we get more unusual volume coming in on this bar. And as the market tries to rally through that level, the volume now diminishes. It's a narrow spread, close in the middle. And the next bar, this is important, closes lower. No demand. That is tradable. If you want to short those areas, that is a tradable short. And let's go and have a look at some of these. Let's talk about the key points of Wyckoff. Always look at the big picture. Use 500 bars or more. Sometimes I use 1,000 bars. And look at more than one time frame. It's very important to not just study one time frame. I study 3 or 4 time frames in the markets I trade. I don't study more than that. Usually 4 time frames are enough for me, depending on what I want to do. Now, what do I mean by that? Do I want to swing trade a currency position, which means I'm looking to be in the trade for 3, 4, 5 days, possibly a week, even longer? Well, if I'm going to do that, I'm not interested in a 5-minute and a 3-minute chart. In fact, I'm probably going to be looking at the hourly and certainly the 4-hour chart, and I might use a 15-minute chart as well, but that's the smallest time frame I would use for swing trading. Now, let's say I'm doing a seminar with an audience like we're doing on Friday. I want to get in and out the market quite quickly to make some money. Then I'm going to start to look at smaller time frames. I tend to use nothing lower than a 3-minute chart. But I have, when the market's moving quickly, used a 1-minute chart. But 3-minute, 5-minute, 15-minute charts are very good time frames to trade. Those 3, and I know Dr. Dayton uses similar time frames to me, to move in and out the market fairly quickly. And remember, you can be in a trade for a week and make $5,000. You can be in a trade for an hour and make $5,000. That's the thing about the market. Depends on your strategy. You best define for yourself what your own strategy is. So look at the big picture. As I said, always look at a minimum of about 500 bars first, as we'll show you. Then start to look for Yao Ming bars. Now, what are they? Well, they're massive volume bars. Yao Ming is a basketball player. Used to play with the Houston Astros or the Rockets, one of the two. I'll have to get that right one day. And he's 7'6". He's a human being. And he's very tall. So remember, volume is activity. And it's the activity that we're looking for. So everything starts for me, personally, with Yao Ming. If I see unusual volume, I always remember when I first moved to Chicago 10 years ago. I'm now back in England. I walked into an office and the guys would come up and say, "Hey, what's going on? What's going on?" That was everyone says it. What's going on? And I always thought to myself, what do they mean by that? So when I apply it to trading, and someone says, "What's going on?" I see Yao Ming and a price bar with high volume, and I say to myself, "What's going on? What is going on?" Some group or groups have become active. There is activity. I better be alert. There's a trading setup coming. That's the first part of the setup, Yao Ming. Daniel's telling me it's the Houston Rockets. Thank you, Daniel. Thank you. So it's the Houston Rockets yeah, I'm going to make a note of that from now on. It's the Houston Rockets. So we look for Yao Ming bars. Then we look at the trend of price. Are we in an uptrend? Are we in a downtrend? Are we in a sideways trend? Always look at the big picture, because you really want to be trading in harmony with the trend of price. Gregory asks, should we look for the wide spread? Very good question, Gregory. I actually look for the narrow spreads. They're much more exciting on high volume. Wide spread bars are good. Narrow spread bars are better. Write that down. Wide spread bars are fine, but narrow spreads on ultra high volume, hey, get excited. You're going to make some money here. Because narrow spreads on high, especially ultra high volume, tell you something's capping the market. Something's putting a lid on it, as we're about to see. My favorite short is what Tom taught me, is the end of a rising market. It's why I'm short gold right now. the end of a rising market. It's my favorite signal, especially when it's confirmed with a no demand bar just after it. And that's exactly what we saw with gold. So look for a change in behavior in the market. Gold changed behavior a few weeks ago. It was going up and now it's going down. It changed behavior because of the end of a rising market. Look for when the smart money are accumulating or distributing an instrument. Everything works on accumulating, which is buying, and distributing. But remember, when professionals distribute, they do so on up bars. That's a price bar that closes higher, not lower, than the bar behind it. And then look at trigger numbers. We're going to talk a lot about these on Wednesday and Thursday. Triggers are areas of support and resistance in the background where the market reapproaches that level and you get a clear indication from the smart money of what they're doing. And if you don't believe that statement to be true, just have a look here at the gold daily chart and have a close look at what's going on, and you'll see it's all in the chart. Look, there's my trigger number, which is the red line, okay? It's there for a reason. It's the top of the previous ultra-high volume bar. Here, we have a gotcha bar. The market gets sold off here and causes the market to fall. Here, they mark the market up to this level, and it goes through it, but there's no volume. There's no activity to take it higher. That is no demand at market top. And that's why gold has fallen, and I think will continue to fall. We may have up days, but at the moment, it's weak. So when accumulation and distribution happens, it's the composite operator or the smart money. So Tom, let me ask you, Wyckoff used the term composite operator. And Wyckoff taught us to look for accumulation and distribution. Can you, number one, explain what the composite operator is? And number two, explain the concept of accumulation and distribution.
Okay, thanks, Gav. Right. Well, as we said, Gavin talks about the smart money or the professional money. These are individual traders that can throw 5,000, 4,000 contracts into the arena, and that's how they do their business. However, we know that during the phase of what we call accumulation, there'd be more than one individual there, because professional money, they tend to follow each other, especially those on the floor or in the exchanges. They can see what the other, they can read and see what's going on, and they may very well join. And that's why they, Wyckoff called them the composite operator. That volume or that area is composed or a composite of all those professional money. And to manufacture or generate an up move, you need to accumulate the underlying stock that's floating around in the stock market, right? And they will do this at certain times, and that's why it takes serious money to absorb. And that's why you see very high volume coming in on these down bars as they're buying, as they're accumulating the underlying stock there. And then as it goes, sometimes it takes some time to accumulate or remove all the suppliers floating around in the market. And if they're bullish, they will accumulate. I mean, I worked for a syndicate, and that's what they did, and that's all they did. Don't forget that when I was there was no futures. There wasn't anything really. All there was you couldn't even trade the indexes. There was individual stocks and shares, of course, options and commodities. And be quite honest, remember telling me, oh, we don't like commodities. They're too risky. So they weren't in the business of taking too much risk either, which was good, a feather in their cap. Right, but they would accumulate a stock, what they call the floating supply. In other words, when a company launches, they have so many shares on offer. Now, most of those shares are taken up by directors. They're taken up by banks for loans. They're in the drawers of people that never look at them at the bottom there. But so what is left floating around that's available is what they call the floating supply. And if you time your buying right in conjunction with the general market, you'll find that you will be able to control that stock and mark it up or down more or less at will. And then that's what generates the bull market. And believe me, that goes on. There were 300 syndicates doing that when I was there in America. 300, and they don't seek publicity. The group I work with, Century Towers, Beverly Hills, right? You went into this building up to the floor, and you go up to this door, and it's bare. Looks like, I mean, a toilet has more marks on it than their door. There was absolutely nothing. And you go in there, and there's all these smart guys there accumulating and trading stock and shares for their money and others. And that's how they made their money. So that is accumulation, which has to take place. I mean, that chart I showed you 15 minutes earlier on, the high volume was them absorbing the supply that was there at that moment, right? And then the test showed that that supply had been removed, and that's what you've got that small up move for going on. But that's a general idea, but that's only a 15-minute chart. Remember, accumulation, you need to really see a daily chart or even a weekly chart. You could see them at work. And but that's accumulation. And then once they've accumulated and you have a bull move or an up move on your hands, right, then they have to at some time or other sell. In other words, distribute. And who do they sell? They have to sell back to the herd, the public, the banks, even fund managers. People that are vulnerable to seek performance will be looking to buy, and of course they get sucked into the market after these bullish up moves and all the good news is coming out. Everything's wonderful, and they have to distribute, and that will in turn make the market weak, and that's accumulation and distribution. Then you get the variations between, I suppose, when nothing much is happening. But once you learn to read these charts, your skill as a trader will kick in. And if you can master that and master your own feelings and judgment, so that you're not overcome by this primitive brain that you've got arguing with your cortex, you know, then you'll be fine.
Okay, I've got a question for you. Right, so Lance is here, and he's got a question. So Lance, I'm just opening your mic up now. How are you? How are you today, Lance?
Very well, thank you. And yourself?
Ah, very good. Yeah, no, not bad at all, and in fine form is the master. You've got some questions, Lance, so shoot away.
Yeah, hello, Tom.
Lance says hello.
Hi, Lance.
He says hi, Lance.
Yeah, basically, it's back to that gold chart. If you could just put that up a second.
Yep, there it is.
Okay. Oh, sorry, let me just move my control panel out of the way. Yeah, it's quite clear to see that the market sort of coming up to a resistance level and gets sold off. We've got the gotcha bar, which is plain to see what's actually happening. And that follows, like you said, with the market being sold off. And then what we get to is, I can't quite make it out on the chart, but could you put where the spring light bar is, where it's sort of accumulated at the bottom?
Down here.
Yeah, the actual spring light bar there, the bar what goes into fresh new low ground.
Down here.
Yeah, what's the volume there? Now there, let's assume that we got short on the wave down. Is that volume on? It's easy to see, Gavin, on the chart, but in real time, as that's happening, is that volume enough to say, okay, that market's now going to start to drift sideways and change behaviour and go back up to that resistance level?
No, there's no way of knowing at that point. I mean, that volume is not ultra high; it's pretty average. So at that point, if I'm short, let's say I would be short from this gotcha bar up here, and I'm now short gold actually on the no demand bar. But forgetting that for a second, let's say we've gone short on this bar here. All right, so you're short on the gotcha bar. You've got two things that are going on here. You've got weakness in the background. You've got selling pressure. The volume that is a high volume up bar. So let's say you're now short. Now, where do you get out the trade? That's a good question.
Yes, that's
all right. And there's two ways of doing it. Okay. Now you can use the software to use what we call these H stops. Okay. Now these H stops here on the daily chart will give you an idea of where to put a stop. But there's something else that we've got in the software. If you hit Control D, can you see now there's a chandelier stop system here? This is basically a line. The idea of trading and what you're trying to do, once you're in a winning position, there's two objectives you've got. Number one, get your stop to break even. Okay, so that's the first objective I always have, is get my stop, because as soon as I take a trade and I'm in the market at a price, I know that I'm going to have a stop that involves me losing money if it goes against me. You with me so far? Yeah?
I understand now, yeah.
Right, so then the next objective, if the market moves in my favour, is to give myself enough breathing room so that if it goes and zips up and down, I don't get stopped out, but I want to get the stop to break even. Now, I probably can show you the trade that I took on the British pound, which will show you this in a bit more detail. Okay. All right. So here, now, I think you were in the seminar last week when I actually said there was a short on an upthrust in the British pound, and we actually got this bar here. This is what actually happened. This was last Thursday when I did the seminar, and I actually shorted an upthrust on a 15-minute chart. Now you can see here that the upthrust came, I think it was around on this bar here on a 15-minute chart. It was showing supply on an hourly chart, but it was confirmed, and we were changing behavior. The market was in a downtrend. Now, this is the sort of move you're looking for. Doesn't happen all the time, but it does happen, where the market is marked down and we have a very high volume bar. Now, the question is, do I want to, I've got high volume on a down bar here. Is that enough suffice for me to say, hey, I'm going to take my money and get out the trade? Well, the software tells me, no, bring your stop down to this level here. Bring it down. So now I'm in profit. I can't lose money. In fact, I was about 80 ticks up at that point. So what happened?
Money management dictates whether you get out or stay in them. Yeah.
Correct.
The money management software dictates it.
Correct. That's exactly right. Is what you're doing is, unless I see an obvious principle that is obvious the market's going to reverse,